Steve Eisman of The Big Short, you don't want to be a hero in this environment. I want to hear what he's talking about in this one. I've been wanting to react to this video for several days now and hear his perspective on the market and how he thinks people should be positioning in this market. So we'll react to that one. I'll give my opinion. Hope you guys enjoy this. As always, thank you everybody that's subscribed here. As always, folks, 24,700 plus subscribers now at this point in time. Before we get into that reaction, I thought I would go over a few comments I saw from the main channel video here today that I think were worth kind of responding to, okay, from a few different angles. And by the way, if you think I don't read comments, I still am happy to go through comments. I don't get to see all the comments, but I try to at least, see some comments see kind of what folks are talking about, perspectives, people are sharing, different things like that, right? And so I was kind of going through a few from that video I released on the main channel earlier today, and this is one comment I saw. It said, I'm not going to go by how the strip is doing, to be honest. The strip, and by the way, so if you didn't get to see that video, basically I was showing it kind of, what I saw on the strip yesterday, the Las Vegas strip, that is, kind of what I've been seeing in let's call it the real world economy, getting off the internet and going out there, right? And I was kind of speaking to that, and I was speaking about how the recession just keeps getting pushed off, and I also talked about how we really had a recession in 2022, in about the middle of 2022, but the government didn't call it a recession, obviously. So I was pointing out all that, right? But anyway, this was somebody that was, and by the way, the strip was packed and it was insane out there in general. So this is just one comment I saw, right? The strip is where people go have birthdays, bachelor parties, etc. They're going to overspend for a weekend, and then they'll be catching up on those credit cards for the rest of the year. Yeah, but you could always say that. That's just the way it is. That's how it goes. I think the better indicators are, Walmart, going to the mall car dealerships. They're bearing a lot of the time. Car dealerships, autos are obviously having a really tough time in this. Anything, I've been calling this out for over a year. I told you guys this would be an issue, right? Anything that's basically you got to take out a big loan for. That's homes and that's autos, right? We'll have a lot of trouble in this economy, and we'll continue to as long as rates are on a higher level, right? Going to the malls are packed from what I'm seeing, very busy still. Walmart's horrible indicator. If you think, Walmart being not busy is a let's call it a bearish indicator, that would actually be the best thing ever. Because if Walmart's not busy, then that means like Walmart sells all needs-based stuff. So if Walmart's not busy, like that would be the best case scenario for the economy. When people are hurting, when they're not doing so well financially, Walmart actually is a huge beneficiary of that. So that point just doesn't make a lot of sense there, right? So, and then they brought out some other points about it. It was, spring break, March Madness. There's always something going on in Vegas. You can say that every single weekend, right? This person says, you can't judge the economy from driving around Vegas, get out of the bubble. So first off, we weren't judging the entire economy based upon how Vegas is doing, but that's a nice way of putting it. But unfortunately, and this is, I think, the problem. I think a lot of people just have opinions on the market and the economy that don't even understand like base level economics, right? Vegas is a definition of discretionary spending, right? No one has to come to Vegas. You go to Vegas because you have clearly too much money and you want to blow a bunch of money. Vegas is extremely expensive, right? When Vegas is dead, the economy is dead. Look back at the great financial crisis and you will see. When the economy was hurting bad in 2008 through 2010, Vegas was in a bad place. The Wynn dropped, Steve Wynn, he dropped the room rates of the Wynn and Encore to under $150 a night for the Wynn and Encore. That's how bad it was here, right? Discretionary spending is Econ 101, something to keep an eye on, right? And so it's very important we keep an eye on all these different triggers in the economy with worries and whatnot. You should always pay attention to this stuff. But like let's be very clear. Going to Vegas is discretionary spending. And when people are in a very bad place, when the economy is in a very bad place, like Vegas is not doing well. I can tell you that. That's been proven throughout history time and time again, okay? And so that was just a very bad point that individual made there, right? This person says market crash is near. As always, retail will be caught flat-footed. Not really, unfortunately. Most retail sold out of this market, left this market. Look at all the stock brokerages. Look at their numbers. Retail, unfortunately, mostly left this market, or retail is now bearish on the market. If you look at like what YouTube channels are doing well and those sorts of things, they're all the bearish channels that are very negative on the economy, very negative, and just anything. The flames in the thumbnails, the whole deal, right? So the fact is, most retail is not even invested right now, and if they are, it's very small investments, and retail is not really buying that heavy, to be honest. Just every data point you want to look at does not point to that. We had that sort of market a couple of years ago, and that was when obviously we were in a FOMO market, right? This person says it's Vegas. People have money there to spend and have a good time. Yeah, once again, that goes back to the discretionary spending whole thing in regards to Vegas, people spending and whatnot, okay? So I think those are important factors, but I think we're living in a different kind of time right now where just everybody seems to have an opinion on, the economy or what's going to happen. Everybody likes to try to predict the next stock market crash, the next recession. And unfortunately, then it doesn't happen, and then they push it off 6 more months, and then they push it off 6 more months, and then they push it off 6 more months. And so you kind of have this never-ending, situation of until the government wants to call it a recession, no one's going to believe it's a recession, right? And then, if it doesn't happen, they'll just keep pushing off. So it's an interesting time period we're going through, nonetheless, folks. Let's get into this. Let's react. I appreciate y'all joining me as always. Much love.
Best risk than they ever had in anyone's lifetime. The European banks, while they're not...
All right, let me start.
Our next guest is known for calling and profiting from the housing crisis. And when it comes to the latest upheaval on Wall Street, Big Short investor Steve Eisman is telling investors, don't be a hero. Steve Eisman is a senior portfolio manager at Neuberger Berman. He joins us here on set. Steve, welcome back to Fast Money. It's great to have you on a day like today. I think, you navigated past crises so well. And so the number one question here is, do you see any sort of a banking crisis unfolding here in the United States and or in Europe?
My partners and I have looked at this really carefully. I would say, number one, the large U.S. banks are better capitalized and have less risk than they ever had in anyone's lifetime. The European banks, while they're...
That's an important factor.
Well capitalized, or certainly better capitalized than they are. That isn't to say there won't be pain if Credit Suisse goes down, but it's not an '08, thankfully.
So not an '08, thankfully. You just heard the person that is extremely bearish, right, all the time. These folks in The Big Short, Michael Burry, all these folks are telling you, this is nothing compared to what the great financial crisis was, right? And these folks definitely understand, I think, the financial system in terms of at least the banking side of it and systemic risk and those sorts of things. I think they understand it better than 99.9999999% of people out there, right? Including better than myself, right? And so when those folks continue to tell you, Michael Burry said this gentleman's saying this, right? Steve Eisman from The Big Short also telling you, this is certainly no '08, right? There's problems in the banking system, but it's not even close. That was a whole different dynamic there.
Party risk in terms of transmission mechanism, that doesn't exist to the extent.
No, it does exist.
It does exist.
It's just, people have been pulling back from Credit Suisse from a long time. If you hear that the company goes bankrupt, there will be losses.
It didn't go bankrupt, by the way. They got bought out.
Death-defying losses. But it'll be a problem. It's not going to take down the system.
In terms of what
we've seen... So he's saying even if Credit Suisse went down, where they went under, which they didn't, they now have been bought out. He's saying even if they did, it still wouldn't take down the system. It wasn't that sort of systemic risk.
Reaction across the European bank sector, I guess it's, everybody wants to get out and then figure out
Well, it's a little bit of what I'd call PTSD from 2008, sell and ask questions later, which is
Thank you.
Bad strategy, because the news is probably just going to get worse. The news... that Switzerland is trying to bail out the company. To give you a perspective, I remember in 2008 when everybody was trying to get bailed out, if you looked at the U.S., the size of U.S. GDP was many multiples bigger than all the bank balance sheets combined. We looked at Credit Suisse today. Credit Suisse balance sheet is $500 billion. The GDP of Switzerland is $800 billion. So could Switzerland do something? Yeah, they could do something. It's not going to be easy. Not easy at all. The other thing I would say about Switzerland, unfortunately, is they really don't have a lot of regulators. So what they actually know is not, I don't think they know a lot.
That's frightening. And also...
In terms of the numbers of, if you look at Germany, what I've heard is 500 regulators in Deutsche Bank every day.
Right.
I think the number of regulators of the Swiss bank, I could be wrong, is 250 for the whole sector.
But that statement paired with the notion that Credit Suisse might be too big to save is sort of a frightening...
Well, it's frightening and it's not franking. It's going to be ugly.
Right.
Credit Suisse, I'll say euphemistically, has been a problem child in the investment banking industry for as long as I can remember. And it's always had cultural issues. But... it'll get unwound. It'll be painful. It's only going to be painful for Switzerland. If we heard today that they maybe want UBS to take it over, believe me, UBS does not want to take it over.
UBS did take it over, just so everybody's clear about that. They did take it over now at this point in time. Obviously, this interview is from a few days ago, but yeah, if you aren't caught up on the news, UBS did go ahead and buy out Credit Suisse.
Sure. So I don't know how they're going to unwind it. They probably will have to. I mean, is it possible that they could save them? Maybe. But, the credit default swaps blew out to like 800 basis points. That means you really can't fund yourselves. I heard that they were offering 6 to 7% deposit rates in Asia, and people were still pulling their money. And nobody will be a counterparty anymore. That's more than bad.
Yeah.
That's really bad. So how Switzerland will deal this, it's anybody's guess. I'm not in the room.
Yeah.
So let's switch to the U.S. for a minute. So with what's happened over the last week that's been revealed, and who knows what hasn't been revealed yet, do you see that we're in a new era now for regional banks, for what the model will be and how to think about the whole banking structure, the whole sort of business of banking?
It's not a 5-minute question. Let's see, where could I start? Let me start with, and when President Trump passed that bill and raised the threshold from, I think it was 50 to 250. Now, I think that was bad. I think Elizabeth Warren has a real valid point about it. But we looked at the stress test for last year. And the stress test for last year had about a line in it about rising rates. And the rest of the entire stress test was about credit. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it.
They would have passed it.
And, the stress test is basically fighting the last battle. That battle has been won in the large banks. They're better capitalized. Their risk, even with that capital, is much narrower. As Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide of a mistake, which is some of the regional banks, especially those that have a lot of deposits above 250, bought long-term bonds at very, very low levels and have massive mark-to-market losses. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base, which has a very big herd mentality.
So it would be very hard
100%. And that herd mentality was everybody sell, get your money out of SVB as soon as possible. So 100%, he hit the nail on the head there.
I mean, even if you apply the stress tests to a Silicon Valley, that may not have detected the interest rate.
The stress test.
You hear them talking about, this is super important for everybody watching this video to understand, right? Is they're talking about if SVB had gone through the stress test, maybe they could have still passed, right? Which goes to show you regulators are going to step up even heavier on the banks now, right? And these babies are going to be regulated on a much higher level, which means essentially in 2024 and beyond, these banks are going to likely provide a lot less return, but are even going to be next level safe in regards to even the smaller banks, because I can tell you they're going to regulate the crap out of them. And so in my opinion, the risk reward from the risk side, I don't think you're going to have even remotely close to the risk in banking sector moving forward. And this goes for the whole kind of gauntlet of banks. In the past, it's only been the big dogs, the Wells Fargos, the JP Morgans, Bank of America, those guys. I think they're going to regulate so heavy. It could definitely hurt earnings potentially, these companies, of these banks specifically. But what I do believe it's going to make for a safer banking system than we've had, because clearly they didn't fix all the problems, right? They fixed it in terms of the biggest of the big dogs, the too big to fails, but they did not fix the banking system overall. It's clear as day when you have these sorts of bank runs that we just had here, right? And all of a sudden you have Credit Suisse and all these other ones, potentially going under. That speaks to the banking system has not been fully fixed. It has been kind of fixed. That's the best way I could put it. The banking system has been kind of fixed since the great financial crisis.
Would not have detected their problems.
Right, their problem, because nobody was looking for an interest rate risk on the balance sheet. You're just looking for
credit.
Liquidity.
And that's what the stress test has been for the last 10 years.
It's hard to think of in trying to figure out whether or not you invest in regional banks, you're trying to figure out, well, what can they regulate to prevent this? This is a very specific situation of interest rate risk, which may not come up again for a long time.
Well, we have it now.
And,
what I would say to that is, so over the weekend, we were thinking, okay, so let's say the government doesn't bail anybody out. So clearly JP Morgan and Bank of America benefit. And it turned out, even though they did get bailed out, JP Morgan and Bank of America benefited. So our first thought was, well, maybe we should buy JP Morgan and Bank of America. And then upon further reflection, we were like, maybe not. Because given what's just happened, all the regulations are probably going to get much more stringent, making the banks much less profitable. And that's not going to be clear for many, many months. So why be a hero? Because you have absolutely no idea what's going to happen.
Would you say that
that's interesting that somebody like him would consider buying some of the biggest bank stocks? That almost speaks volumes to if you own any of those stocks, which the only banking related stock I own and have owned is JP Morgan, right? I think for a very short amount of time, years ago, I think I owned Goldman Sachs for a small amount of time, but been in the market 15 years. And those are only two I've ever owned, and there's only one I currently own, which is JP Morgan, right? And it just speaks volumes to the quality of that specific name versus anything else in kind of the banking system, that even somebody like a Steve Eisman was having serious considerations about buying that, specific stock. I'm thinking about buying JP Morgan. Like that's a whole other level when you can get somebody like him to even say, you know what, I'm thinking about buying it. But he's speaking to the same exact point I was just making a minute ago around, if the more regulation comes, yeah, it's going to make you safer. But at the same time, you're not going to have nearly as much upside, right? Because when the banks can operate like Wild Wild West, they can really push profitability and they can, have some insane gains, but they start taking major, major risk. And that's why we have to regulate the crap out of these banks, because they can't do it themselves.
Sector right now with the uncertainty given what will happen on a regulation front, that financials are uninvestable right now?
I would say, we were looking as a team at every single bank. And I would say, given the change in the regulations, the best you can say is you don't know. And if you don't know, you shouldn't play.
Wow.
Fair.
So then what do you do? Let's say you clear out your position because
Melissa Lee, I don't think that's a shocking revelation for somebody like a Steve Eisman, The Big Short, and in that group of guys, to not want to own a bank. I mean, to be quite frank, that should come as no surprise in my personal opinion.
And we don't know. We don't want to play in this pool. What pool do you go to?
Well, that's not an easy question.
Well, yeah, but
I think what's happening is we're moving from one paradigm to another paradigm. Mm-hmm. So the paradigm of the last several years has been rates are very low, you're paid to take risk, and you're actually paid to take a lot of risk. So, what did the best over the last 10 years? High growth tech stocks. And what did the best within high growth tech stocks? Super high growth revenue stocks with negative earnings. Okay, so what did the worst last year? Super high growth stocks with negative earnings. Now, are people going to go back to that? I don't think so, especially if rates stay up. Mm-hmm. So what I think is coming is Tina is dead. Number one, I think you're going to have a much more diversified portfolio. You certainly can leave money in your money market fund because it's over 4%. I'm not sure if it's over 4% tomorrow.
Maybe not
but
anymore.
It's still around 4, which is fine. I think over time, you'll be able to buy some treasuries and buy some bonds. And there are going to be a lot more themes than just tech, infrastructure, bringing the supply chain back to the United States. And you're going to need to manage risk a lot more than people have. So, people who's outperformed over the last 10 years? Tech investors. The group is now so volatile, I think everybody should take their exposures down. Not that you should invest in tech at all, but you really should diversify more of your portfolio, take down your risk, manage your risk, tailor your portfolios to your clients. One size does not fit all. And given the fact that, my team and my partners and I, we go back every single day. Is there a recession? Is there not a recession?
Ooh, well, let's hear what he has to say about recession. But important point, he's talking about portfolio strategy, building out your portfolio, right? And basically what he's saying is my strategy of GVD, right? Growth, value, dividends. You've got to be a combo. He's saying don't, say you can't own anything tech related, right? Or anything growth related. but you need to also be focused on other opportunities in the market, right? Which in some of those industries, definitely it falls into, some of those sectors fall into more value stocks and dividend stocks, and building out this overall great portfolio of many various stocks, right? And if I look through like my portfolio, whether it's a public account or whether it's the new Patreon portfolio, which by the way, if you're looking to get access to that Patreon portfolio and all the moves I'm ever making in that account, the buys and sells, plus support the channel, that's in the description area. It might also be pinned comment down there. But if you look at that Patreon portfolio, it's the perfect example of a combination of growth, value, dividends. And if you go through those, every single stock serves one of those purposes in there. It's either a growth stock or it's a dividend stock, or it could be potentially a value stock. Everything serves a purpose in there. And so I think that's a great point he brings out. And I think that's something everybody should adapt, because if you're only one way, you're setting yourself up for some very hard times. If your let's call it your space isn't quite hitting, right? If treasuries are really high, that hurts dividend stocks in a meaningful way, right? Which makes buying opportunities, but it means you're not likely getting that very good performance, let's call it that, right? If interest rates are very high in general, growth stocks many times have struggles, right? If you're talking about a situation where there's a lot of uncertainty, you can have growth stocks kind of be in a tough place. If there's more certainty, next thing you know, growth stocks can start to rally, and they can start rallying much more than value and divs. Look at the performance of, let's say, a good example is like NVIDIA, right? NVIDIA, a company everybody in Wall Street knows, everybody in the market knows NVIDIA, right? And you look at a company like NVIDIA, it's up 130 or 140% from its bottom it reached a few months ago. Are you going to get that sort of performance in a dividend or a value stock that's a famous stock? Absolutely not. Is Coca-Cola going to go up 140% in a matter of a few months? No. Is Pepsi going to go? No. Okay. And so if you go through those sorts of stocks, is my Foot Locker stock going to go? No. I wish that would happen. Nordstrom and all those? No. That's not the way those type of stocks perform. You'd be lucky to get 140% over several years, not several months. But for those sorts of game-changing companies that have great long-term trajectories for the next 5-10 years, plus have a very impressive past 5 to 10 years, that's where you're really talking about, companies with great past and futures. And your portfolio is all about that risk-reward, right? 10 to 20 stocks in your portfolio. Take advantage, growth, value, dividends.
I watch your show. You've had people come on and say there is a recession, and a month later they said it's not a recession. It's a very uncertain time because we've never had the confluence of stuff that we have today. And I think that argues for taking less risk.
Right.
But Steve,
go ahead.
So if we haven't had recession yet, and the S&P never bottoms before a recession, in terms of market sequencing, and the fact that we've seen these credit reverberations and bubbles just start. I mean, how do you see this playing out, both in terms of, you don't need to give us the crystal ball on levels on the S&P.
In terms of recession, if I told you this, okay, if I told you the stock market's crashing, if I told you real estate was starting to pull back in a major way when it comes to mortgage applications, if I was telling you consumer sentiment was the lowest it was in history, all simultaneously while executives were getting very uncertain and you had super high inflation, what would you tell me? You would tell me that sounds like a recession, right? And what if I told you that's exactly what happened in the middle of 2022? Exactly what happened, right? The stock market was crashing in terms of mortgage demand. It started drying up massively. We obviously had super high inflation. We obviously had real wages going down substantially quarter after quarter after quarter. And we had consumer sentiment around June, July hit the lowest we've ever seen in the history of consumer sentiment. In the history. When you put all that together, that screams recession, right? Oh, plus we had the definition of recession, which was 2 straight quarters of negative GDP. So we had it. We had it all. That's why I say we already had a recession in 2022. Doesn't mean we can't have one in the future. I'm just saying, we need to call it what it was. And just because there was one data point that wasn't lining up, which was unemployment rate, it doesn't mean everything else is forgotten. Because that one data point, although important, there's a lot of other very important things when it comes to the economy and understanding it.
Talk about next week, for example. At the beginning of the year, good news was good, bad news was bad. And then in February, good news was bad, bad news was good. And now let's talk about next week. So, 50 basis points is off the table. So either they're going to do 25 basis points or they're going to do nothing. So let's start with the nothing. I got calls for today that, because of Credit Suisse, maybe the Fed will do nothing, and that's really positive. And my response was, really? You're rooting for a financial crisis so that the Fed won't raise rates? If the Fed doesn't raise rates, maybe it'll be positive for a couple of hours or a couple of weeks. But the Fed won't be raising rates because it's scared. Well, if the Fed is scared, you should be scared. Mm-hmm. On the other hand, if the Fed raises rates even in the face of this by 25 basis points and says that we're not we still could raise more, then that's like, wait a minute, you're sort of caught between a rock and a hard place. Financial conditions have really tightened, but you still have inflation. It's not clear either move is good.
I want to go back to the ramifications of the regional bank fallout. You said you wouldn't want to play given, the uncertainty there, but does that also mean that you wouldn't short anything? And does that also mean that you're not also looking at some of the ripple effects, perhaps maybe on commercial real estate, if they have less access to capital because of tighter?
I don't want to talk about individual shorts.
Sure. Okay.
Do I think the banking sector is still a short?
Smart man. Don't speak about your short, especially publicly.
Imploded. So, would you want to short some of the bank stocks after some of them are down 60, 70%? Got to have a lot of guts to do that. Probably better just to mostly stay away. Do I think commercial real estate, well, not commercial real estate, office real estate is going to be a problem? Yeah, we do. We think office real estate, but the way these things unfold, it takes a long time. I think what the catalyst will be, it really depends on each company when their debt rolls over. If somebody bought that building 2 years ago with long-term debt at 3%,
right,
and let's say it's 5-year paper, and in 5 years it's going to roll over and it's going to be 7%, that's not good. But it really depends on each building and each company how much debt they have rolling over.
Right.
That's a great point. Yeah, so he obviously sees issues with office real estate there. So interesting thoughts. In kind of my opinion, in this environment, you've got to be a buyer of great quality companies that are at very attractive prices. That's my personal opinion. There's a lot of opportunities in this market. You got to continue to take advantage of those deals. Don't try to think you're going to be able to time this stuff out perfect, and like a lot of these Wall Streeters do, because they're just missing opportunities all over the place. So continue to miss opportunities, because then the market might go down, and then they're going to say, oh, it should go down more, and then they'll miss that opportunity, right? And so you don't want to play that game. At the end of the day, when you research these companies, you're looking at the valuations of them. If you see an attractive opportunity, go take that opportunity, okay? If it's not attractive and you're like, it's a bad price, I'm going to get a bad return over the next 5 years, then stay away. It's not worth it. But at the end of the day, if you want to talk about getting to the big boy levels, okay, $1 million plus portfolio, right? You've got to take advantage of opportunities. I don't know anybody, I've never seen anybody that reached, 7 figures plus in the market and didn't get there by taking advantage of opportunities in the market. Like, everybody takes advantage. They see an opportunity and they buy the stock. And, you can't have success in the market without taking advantage of those opportunities. Regardless of what you feel is going to happen in the economy or the market, or I think it could go down to 3,200, the S&P, or I think we can have this or that. Your opinion's just irrelevant, right? All these people predicting all this stuff all the time, and most of the time it's wrong. That's a sucker's game. You got to look at specific companies, find the opportunities, take advantage, build a great diversified portfolio, and boom, growth value dividends, baby. Appreciate y'all. Much love as always. If you want to learn from me on a more direct basis, obviously check out the private stock group, the private wealth group. I have immense amounts of course curriculums that teach you everything I know up here in those course curriculums, as well as be part of our private wealth Discord chat and all those sorts of things as well. That's going to be in the description area. If you're looking to join us on the Patreon, see that portfolio, see all the moves I'm making, then go ahead and check out the description area as well. Appreciate y'all and have a great day.